Welcome to today's deep dive. Usually when we think about safety, especially financial safety, we picture a vault.
Right, like a massive steel door.
Yeah, exactly. Thick concrete wall, something completely immovable. You put your money in, you lock it, and you just, you don't worry about it.
It's the ultimate set it and forget it mechanism.
Totally.
A bedrock of certainty that the entire traditional financial system essentially relies on to function.
But imagine if you went down to the basement to check on that vault, and you realize those thick walls weren't made of concrete at all.
Oh, boy.
Yeah, they're made of ice. And suddenly the room is getting just a little bit warm.
That is a terrifying image for an investor.
Right. That immovable safety net is slowly, quietly starting to drip.
And that visual captures the psychological shift happening in global finance right now. Because the traditional definition of a safe asset is quite literally melting for a lot of institutional and, well, retail investors too.
Yeah, the foundation they built their portfolios on is just changing states. And that brings us to the mission of today's deep dive. We are looking at a really comprehensive market analysis article for you today.
Yeah, it's a fascinating piece.
It really is. It's from May 22, 2026, published on the Gold IRA Company's Bulletin platform.
Written by Doug Young, right?
Right, Doug Young. He's a financial markets researcher, a former financial director with over 20 years of experience. And the headline alone is a total showstopper.
Oh, absolutely.
It asks, could silver surge to $300 next?
I mean, it's a headline that demands a lot of context.
Oh, for sure.
Because throwing out a number like $300 an ounce for silver, it requires dissecting some massive macroeconomic tectonic plates that are shifting under our feet right now.
Which is exactly our goal today for you, the listener.
Yeah.
We want to cut through all the financial noise out there.
Right.
We're going to unpack the underlying dynamics shaping silver's trajectory right now.
But decoding that complex relationship between global debt, industrial demand, and precious metals.
Exactly. And ultimately, figure out exactly what this means for your financial awareness. But I do want to note right up front, this is purely educational market analysis.
Yes. Very important disclaimer.
Right. We are exploring the mechanics of these markets. We are not giving financial advice.
Because markets are inherently unpredictable.
Totally.
We're looking at the atmospheric pressures that create the storm systems, not, telling you what day to carry an umbrella.
I like that. Okay, let's unpack this, because to understand why everyone is suddenly talking about silver, we actually have to start by talking about something entirely different.
Exactly. Perceived as completely safe because they are backed by the taxing authority of governments. But a bond yield, which is the interest the government pays you to hold that debt, it functions as a real-time barometer of risk.
Okay, wait. I want to push back on the mechanics of that for a second.
Sure.
Because I think this trips a lot of people up. If bond yields are rising, doesn't that inherently mean bonds are paying you more money?
Well, nominally, yes.
Right. So if I'm an investor and the government is suddenly offering me a 5 or 6% payout instead of a 2% payout,
Yeah.
why does that make me run away from bonds and toward a chunk of metal that yields absolutely zero interest?
It's a great question. To understand that, we have to separate nominal yield from real yield.
Okay.
The nominal yield is just the number printed on the tin. Like you said, let's say it's 5%.
Right.
But if the inflation rate in the broader economy is running at 6 or 7%, your real yield is actually negative.
Oh, wow.
Yeah, so you are basically locking your money up for 10 years to mathematically guarantee a loss in purchasing power.
Because the money I get back buys fewer groceries, less gas, less housing than the money I put in.
Exactly, even with the interest included.
That's rough.
Right. And those rising yields reflect a growing risk premium. Institutional investors look at the sheer scale of sovereign debt. We're talking trillions upon trillions of dollars.
It's unfathomable, really.
It is. And they realize that mathematically, governments cannot afford to pay off that debt with hard, valuable currency.
So what are their options?
They basically have two choices. Default, which is highly unlikely for a country that prints its own money.
Right, they'll just print more.
Exactly. Which leads to the second choice, currency devaluation.
Ah.
That's historically the default mechanism for escaping massive debt. They print more money to service the debt, which drives up inflation.
I see.
So that higher bond yield isn't a generous gift from the government. It's a distress signal from the market. They're demanding compensation for the melting ice vault.
Wow. Okay, so if institutional asset managers are, literally mandated to preserve purchasing power and bonds are guaranteeing a real loss, They mechanically have to pivot.
They have no other choice. Capital gets forced to search for alternative safety nets.
Uncorrelated assets.
Exactly. Assets that hedge against inflation and currency devaluation.
And that explains the bridge to commodities and precious metals. But why silver specifically? I mean, why not just pile everything into gold?
Well, the article points out that silver has this fascinating dual nature.
Right, it's not just money.
Exactly. It occupies a very unique space in the periodic table and the global economy. Gold is almost purely a monetary asset.
It just sits in a vault looking pretty.
Pretty much. It acts as a store of value, but silver is different. It is the most electrically conductive metal on Earth.
And thermally conductive, right?
Yes, the most thermally conductive too. It is an absolute industrial powerhouse while simultaneously maintaining thousands of years of history as a monetary metal.
It's like a character living a double life.
How do you mean?
Like, it's an industrial workhorse by day, sweating it out in manufacturing plants. But by night, it still have its monetary safe haven superhero status backing it up.
That is a perfect analogy. And the industrial side of the equation is getting incredibly demanding right now.
Yeah, the source material really highlights China here.
Absolutely. They are rapidly becoming a dominant buyer.
Mostly driven by huge demand for manufacturing solar panels and electronics, right?
Right. And what's fascinating here is how this industrial demand is fundamentally shifting the geographic center of gravity for the metal.
Okay, break that down for us.
Well, global trade data shows massive amounts of silver being routed through Asia. For decades, the reference price for silver.
The spot price you see on your screen.
Yes, exactly. That price has been heavily dictated by Western financial hubs.
Like New York or London.
Right, primarily through paper futures contracts on exchanges like the COMEX in New York or the LBMA in London.
Okay, I want to stop right there and clarify this mechanism. Because the difference between paper silver and physical silver seems absolutely crucial to this whole $300 thesis.
It is the crux of the argument.
Right, so how exactly do paper contracts set the price for an actual physical rock?
So in Western financial markets, institutions trade contracts that represent a promise to deliver silver at a future date.
Okay.
But it operates on a fractional reserve system. There are vastly more paper claims to silver than there are physical ounces sitting in the vaults backing those claims.
Wait, really? So they're trading silver that doesn't actually exist?
Mostly, yes. Most traders never intend to take delivery of the metal anyway. They just settle the contract in cash to capture the price difference.
I see.
But the volume of this paper trading is so massive that it effectively dictates the global price.
But a solar panel manufacturer in China can't build a photovoltaic cell out of a paper futures contract.
No, they cannot.
They need the physical atoms of silver.
And that is the friction point. When Eastern industrial powers demand physical delivery of the metal.
Because they actually need to use it.
Right. When they pull it out of Western vaults to put into solar panels and electric vehicles, that fractional reserve system gets extremely stressed.
Like a bank run, almost.
Exactly like a bank run. If the paper market realizes there isn't enough physical metal to satisfy the outstanding claims, you get a short squeeze.
Wow.
Physical supply tightens, the leverage breaks down, and the price of the actual metal detaches entirely from the paper derivatives.
That makes total sense. This is why the reference price could bypass the West entirely, as the physical metal just drains to the East.
Exactly.
But let me play devil's advocate here on the industrial demand side.
Go for it.
If silver relies so heavily on manufacturing, solar panels, EVs, electronics, wouldn't a global economic slowdown completely crash that demand?
It's a very valid concern.
Like if we hit a severe recession, consumer spending drops, nobody's building new solar farms, factory orders plummet. Doesn't that just cripple silver's price, regardless of its appeal as a safe haven asset?
That tension is exactly why silver is notoriously more volatile than gold. You are describing the tug-of-war inherent in its dual nature.
Right.
In the initial shock of a severe recession, industrial demand does drop, and you almost always see a massive liquidation event where the price of silver crashes alongside equities.
So it falls with the stock market?
Yes.
Okay.
We saw this in 2008, and we
Yeah.
saw it again in 2020.
Right.
However, central banks respond to those severe recessions by slashing interest rates and printing currency to stimulate the economy.
Which immediately triggers the monetary side of silver's personality.
Exactly. The industrial price crash is almost immediately followed by a monetary price explosion because investors see the currency devaluation coming.
It's a total whiplash effect.
It really is.
Which sets up the reality of the market described in the article. Because early in 2026, we saw a violent movement.
Very violent.
A rapid, steep rally followed by a sharp intraday correction that erased substantial gains in a matter of hours.
Yeah.
And now the metal is sitting in what analysts call a sideways consolidation band.
Right. Consolidation is basically a period of equilibrium.
Just taking a breath.
Exactly. The aggressive buyers have exhausted their capital, and the aggressive sellers have liquidated their positions. The market trades sideways, digesting the recent move.
Makes sense.
Technical analysts look at this pattern as a natural pause within a broader macro upward trend. But as Doug Young's research points out, technical analysis is a framework for probability, not a guarantee.
Here's where it gets really interesting, because when an investor looks at a volatile, whiplashing market and then sees a headline throwing around a massive target like $300 an ounce.
The FOMO kicks in.
Yes. The psychological instinct is to panic buy. The fear of missing out takes over completely, but the author is meticulous about contextualizing what that number actually represents.
Absolutely. A $300 target is an extreme, long-term scenario.
It is not an actionable trading level for next Tuesday.
No, definitely not.
It's like predicting your local sports team will win the championship 10 years from now.
Oh, I like that.
Like, is it mathematically possible? Sure, yes. But it requires an incredibly specific chain of extreme events to unfold perfectly over a long time.
Precisely. The article outlines that reaching $300 silver requires severe macro conditions.
Like what?
Like a catastrophic sovereign debt crisis where bond markets just freeze entirely. Or a total breakdown in confidence regarding fiat currencies. Or, like we discussed, a sustained, multi-year surge in physical demand that visibly empties Western vaults and breaks the paper market completely.
And even if the global economy is marching steadily toward those extreme scenarios, the price action won't just be a straight line up.
No, it never is.
The article highlights the concept of stepwise rallies.
Yes, stepwise rallies are crucial to understand.
Let's break down the mechanics of a stepwise rally, because I think a lot of people just assume a bull market goes up every single day.
Right. Commodities climb stairs, but they do it violently.
Violently?
Yeah, you experience a massive surge upward. That's the step. But that surge triggers institutional profit-taking. Algorithms hit their sell targets, early investors cash out, and the price drops sharply.
Which forms the landing of the stair.
Exactly. It consolidates there before the next catalyst triggers the next step up. Analysts projecting triple-digit silver are anticipating brutal 30% drawdowns along the way.
30%? That's huge.
It is. If you don't understand the mechanics of the stepwise rally, the volatility will shake you out of your position on the very first pullback.
You'll panic sell.
Exactly.
So if a listener digests all of this, the negative real bond yields, the shift to Eastern physical demand, the paper market leverage, the stepwise volatility.
It's a lot to take in.
It is a lot.
Yeah.
But if they digest it and they decide they actually want exposure to this macroeconomic shift, how do they actually execute that? And what external forces could just derail their whole thesis?
Well, the first external force to monitor is gold.
Gold?
Yes. Gold is the foundational bedrock of the precious metals sector. Because it has a longer history as a primary reserve asset for central banks, it acts as the leading indicator. When gold enters a consolidation phase or breaks out to new highs, it provides the psychological cover for capital to move into the broader metals complex.
So silver essentially acts as a high beta version of gold.
Exactly. If the macroeconomic narrative for gold breaks down, say, central banks magically balance their budgets and inflation drops to zero.
Not likely, but hypothetically.
Right, hypothetically. If that happens, silver's monetary premium will just evaporate.
Okay, let's assume gold remains strong and the monetary narrative holds. The investor essentially has two main paths for silver exposure, right?
Yes, generally speaking.
Buying the physical metal itself, like coins and bars, or buying equities in the mining sector. The company's actually pulling the rock out of the ground.
And those two vehicles carry drastically different risk profiles.
I think the best way to visualize this is the difference between buying a physical painting versus buying shares in the art gallery that sells the painting.
That's a great way to look at it.
All right, because if I own the canvas, my only variable is the art market's demand for that specific piece. But if I buy shares in the gallery, my investment is suddenly tied to a whole host of operational metrics. Did the landlord double the gallery's rent?
Is the gallery manager competent?
Exactly. Did a pipe burst and ruin the inventory?
And that maps perfectly to the precious metal space. With physical silver, you take possession of the asset. You eliminate counterparty risk entirely.
But with the miners?
With mining equities, You are exposed to management performance, geopolitical risks if the mine is located in an unstable jurisdiction,
Right.
and most importantly, massive input costs.
This raises an important question. What happens to a miner when the cost of extracting the metal skyrockets?
It can be devastating.
Because the article specifically focuses on energy, electricity, and oil as a primary vulnerability here.
Mining is arguably one of the most energy-intensive industries on the planet.
I bet.
You are blasting millions of tons of solid rock. You are loading it into Caterpillar haul trucks that burn hundreds of gallons of diesel fuel a day.
Wow.
You are running massive ball mills to crush the ore and chemical processing plants to extract the silver. Energy is the core input cost.
So let's look at the mechanics of a geopolitical shock. Say a conflict breaks out in a major oil-producing region.
Okay.
The price of crude oil spikes to, let's say, $150 a barrel.
Easily possible.
Right. And that same global panic might drive investors into silver, pushing the price of the metal up to $40 an ounce.
But the miner extracting that silver doesn't necessarily see a windfall.
Why not? The price of their product just went up.
True, but the diesel fuel powering their fleet just doubled in price.
Oh.
The electricity grid powering their crushers just spiked. Their profit margins get compressed from the bottom up.
Man, this means the actual metal could be having a historic bull run. But your portfolio of silver mining stocks could be flat or even losing money because their operational costs just ate all the revenue.
Which demonstrates why equity market performance and metal price performance frequently decouple.
They don't move in lockstep.
Not at all. It all loops back to the broader, interconnected commodity web the researcher outlined. You cannot isolate silver in a vacuum.
Right.
A country running a massive trade surplus might suddenly prioritize hoarding energy commodities, like oil and natural gas, over precious metals to secure their power grid.
Which instantly shifts global capital flows.
Exactly, draining liquidity from the mining sector.
So what does this all mean? Zooming all the way out and bringing it back to you, the listener.
It means macroeconomic architecture is fundamentally changing.
Totally. The traditional sovereign bonds that used to provide risk-free yield are now offering return-free risk due to inflation and massive debt issuance.
Yeah.
And this mathematical reality makes alternative, tangible stores of value like silver highly attractive.
Because they carry no counterparty risk and sit entirely outside the fiat debt system.
But that utility demands a specific temperament from the investor. Silver generates zero yield.
No quarterly dividends here.
Right. And it remains exceptionally volatile as it gets violently pulled between its role in industrial supply chains and its historical role as a monetary life raft.
Which is why the core message from Doug Young's analysis isn't about blindly chasing a $300 price target.
It's an invitation to revisit the foundational principles of diversification.
Absolutely.
It's about auditing your own portfolio, understanding your time horizon, and realizing that holding an asset purely for price appreciation is very different from holding an asset as structural insurance against a melting financial vault.
It requires an understanding of market mechanics, knowing why paper leverage affects physical delivery, or why nominal yields mask real losses, that insulates you against the panic and euphoria driven by sensational headlines.
And if you are intrigued by the mechanics we've been unpacking today, if you want to dive deeper into the relationship between global debt, tangible assets, and the specific research shaping these markets, we highly recommend exploring the primary source.
It's a great read.
It really is. You can find a wealth of related analysis at the Gold IRA Companies Bulletin website. You just go to goldiracompaniescompared.com. Let me spell that out clearly for you. That's Gold IRA Companiescompared.com. And to make it easy, we've put a direct link to this information right in the deep dive notes.
It's vital research to digest as these macroeconomic forces accelerate.
For sure.
Because stepping back from the charts and the yields, it leaves us with a truly profound contradiction to consider.
What's that?
Well, we live in an era aggressively pushing toward dematerialization. We are building a fully digital economy, championing frictionless digital currencies, and storing our wealth as invisible data floating in cloud servers.
Right. Everything is in the cloud.
We are constantly told the future of finance is entirely intangible. Yet, when systemic anxiety peaks, when massive institutions and central banks look at the sheer unsustainable scale of the digital debt they've engineered.
When they realize the ice vault is melting.
Exactly. When they realize that they don't buy more digital promises, they quietly, systematically start hoarding the oldest, heaviest, most fundamentally physical assets in human history?
They reach for the metal.
They do. And you have to wonder what it says about the true stability of our modern invisible economy when the ultimate institutional backup plan is still a heavy piece of rock pulled from the dirt.